Good afternoon to everyone. Thank you for joining today's bankenimpuls of the Association of German Banks. My name is Michaela Zadler, Head of Banking Supervision and Accounting. I'm joined by my colleagues Ingmar Wohlfahrt and Sebastian Moll, both proven experts in banking regulation. 2026, Europe's turning point in banking regulation? A provocative thesis whose background and implications we would like to discuss with you today. We intend to proceed as follows. First, we look back and briefly outline the origins of the discussion and the basic diagnosis of the current state of the European banking regulation. Then, we briefly present the most important opinions and contributions to the debate. We will highlight selected topics as the range of the discussion points is so broad that we can impossibly cover all of them today. Finally, we look forward to answering your questions, which you can send us during this event via the chat function. As for now, I would like to draw your attention to the following slides. Simplification in itself is not an end in itself. Rather, the desire for simplification stems from the understanding that Europe must become more independent, more sovereign, and thus more competitive in the realignment of the major powers. After months of research, Mario Draghi determined in September 2024 that Europe needs to invest a by now famous sum of 800 billion euro and concluded that we were too bureaucratic and too cumbersome. This applies to many different areas of the European economy, but especially to the financial sector. This finding initiated a simplification agenda of the European Commission and made many other European institutions think of options. The next slide shows us the current state of the European banking regulation. In theory, we have clearly distinguishable supervisory instruments and clearly assigned responsibilities. There are risk-based regulations and backstop regimes for capital and liquidity requirements for banks operating with a long-term perspective, so-called going concern status. At the same time, we have a set of rules for the worst-case scenario in the resolution framework. But in reality, the system is extremely complex. There are too many supervisory instruments and a lot of overlaps in between them. The same risks may be priced with capital over and over again. There's too few cooperation between the responsible institutions, leading to extra capital, parallel requirements, and an excessive reporting burden. On top, requirements may change constantly, and there is a high degree of uncertainty about the final outcome. All in all, not really a booster for competitiveness. What do you think? The diagnosis has been widely shared by many different stakeholders, leading to a lot of thinking and paper in 2025. On the next slide, you can see who participated in this competition for ideas for a simpler regulatory framework and more efficient supervisory practices. Noticeable to the public, in July, there was a leak of two so-called non-papers of BaFin and Bundesbank, originally developed only for an internal discussion among the supervisors within the so-called high-level task force, a body which was set up within the ECB, grouping together interested central banks who aimed at searching for a simpler regulatory framework. A few months later, the EBA, after months of work, published a report on more efficiency, mainly concentrating of how to simplify the so-called level 2 and level 3 legislations. In November, finally, the German banking industry also came up with a paper after months of intensive thinking and debating what we thought would be a good solution for a simpler framework. We will later on come back to that. And finally, on the 11th of December, the long-awaited report of the high-level task force was published, and on the same day, the SSM published its agenda for simpler and more efficient supervisory practices. That was last year. What is going to happen this year? Today, Politico announced that the EPP, you will know that this is the Conservative Party of the European Parliament, will push for strong changes in the regulation. The Commission is supposed to come up with a report this year and announce that they will start with the consultation for it anytime in the near future. So, what is this discussion precisely all about? Sebastian, what is, in your opinion, the central topic of the debate?
Well, first of all, thank you for having us. And to answer your question, I think the most prominent topic right now up for discussion is the design and the composition of the capital stack that determines how much and what quality of capital a bank must hold. I think one can easily spot from the graph on the next slide that this framework has become quite complex over the years. In practice, banks must manage their capital along 3 dimensions. Vertically, with minimum requirements, buffers, and add-ons. Horizontally, as Michaela already told you so, between going concern and gone concern, and all of that along the different definitions and qualities of capital that exist prudentially. Now, why is this a problem? From a bank's perspective, the coexistence of such many different objectives, to be specific, having to comply with 8 different stacks, make it harder to optimize capital planning. And this leads inevitably to inefficient capital. But also from a supervisory perspective, the current situation is far from optimal. Because in theory, one would expect you would take a holistic approach. There would be one actor or a actor that ensures that in the end, the capital demanded from each bank is suitable and appropriate. But in practice, no such actor exists in Europe. Instead, competencies of these different pieces are scattered around at national and European levels. This creates, at least in our view, a tendency to overshoot, since every authority acts conservatively by itself and the different requirements are just added up in the end effectively. Also, according to both our members as well as the ECB, international investors often report they struggle to understand the complexity of the European capital stack. They also dislike its unpredictability, which makes investing in European banks less attractive compared to peers. Those are just some of the reasons why both industry and supervisors kind of agree there is real potential to simplify here. The capital stack is too complex, too volatile, too unpredictable, and we might even add uneven or unlevel because Europe has a little bit of gold plating here with a systemic risk buffer. On the next slide, we can see what the ECB high-level task force actually proposes. On the horizontal side, for the going concern, they want to exclude AT1 and Tier 2. Meanwhile, for the gone concern, they only want to allow AT1 and Tier 2 and subordinated liabilities. They also propose to define MREL as a clear on-top requirement on the going concern stack. This would result in a reduction of capital stacks from 8 to 4. On the vertical side, they want to streamline buffers and make it more clear. They want to end up with just 2 buffers, a non-releasable Pillar 2 buffer and a releasable buffer. The problem with these proposals is, however, that the calibration and the details remain largely open. The ECB does not specify whether or how AT1 and Tier 2 would be replaced. Given that we have about 400 billion euros in AT1 and Tier 2 in the system, a full swap into CET1 is impossible to imagine. Therefore, the ECB only outlines a broad range of options from 0 to 100% conversion rate. Within the German Banking Association, in the report that Michaela has already mentioned, we have also dealt with this topic. I will not get into the nitty-gritty on the next slide regarding our proposal for the capital stack, but I want to stress 3 points on the next slide. First of all, for the vertical stack, there is real room to simplification here. We have to reduce the number of different buffers, make it more clear. We also have to think about reducing European gold plating, notably with the systemic risk buffer. Also, and the second point is, I think we have to move into a system where a single overall responsibility assesses holistically the appropriateness of each bank's total capital stack. This may require redistributing competencies or simply empower an authority to rebalance or cap requirements where the aggregate level becomes too excessive. We think, this would reduce the likelihood for overshooting and also increase the predictability of these capital stacks. Lastly, I think we have to make simplification substantial this time. It should not end up being just a facelift of the facade. Equally important, and this is my final comment, simplification must not result in even more gold plating for Europe. This is especially relevant with regards to AT1.
Thank you, Sebastian. When it comes to complexity, in my opinion, there's no other topic which can beat that one up. Ingmar, which is the topic closest to your heart?
Close to my heart, or for me, I think the most important point in this debate was the idea of a small bank regime. But before coming to the details, let me briefly explain why the topic is relevant. Small banks play a significant role in financing small and medium-sized enterprises in Europe and the regional economy. On the next slide, on this slide, no, the one before.
We are a little confused here.
Yes, on this slide, you can see the distribution of small banks in Europe and the share and importance of small and medium-sized enterprises. So no surprise in Germany, the small banks, most of the small banks are located in Germany, followed by Austria and Italy. We want to highlight the smaller member states in Europe, for example, Slovenia or Cyprus. There, of course, you have some small banks, but naturally, the 3 largest banks in each country are automatically counted as significant institutions. So from our perspective, for example, in Slovenia or Cyprus, these are small banks and they are not showed in this graph. So we want to highlight that the importance of small banks is a European issue. Small banks are an important and reliable partner for local customers. During the financial crisis, This diversity of the banking market contributes to the stability and resilience of the financial system and also had a positive effect on the competition. The ever-increasing expansion of regulatory requirements in the last years jeopardizes this diversity and thus also the financing of the European economy. In this respect, regulation tailored to the need of such institutions, like already in Switzerland, the United Kingdom, or even in the United States, is essential. The non-paper of BaFin and Bundesbank, Michaela already mentioned before, proposed the idea of a small bank regime. This broke the ice and had a large impact on the debate in Europe. The ECB and the EBA also commented on this, albeit less detailed. The central idea of a small bank regime is to significantly reduce regulatory burden in exchange of a high non-risk-based capital requirement in form of the leverage ratio. What would a small bank regime look like? So please, the next slide. Yeah. To be able to take part in such a regime, some criteria have to be fulfilled. Some of these criteria are well known because they already exist in the CAR, like a certain threshold for the balance sheet or a small trading book. What is new? The threshold for the balance sheet, with its currently set at 5 billion euro, shall be increased up to 10 billion euro. The, let me say, major innovation I've already mentioned is to introduce a significantly higher leverage ratio than the current 3% to ensure a high level of safety. This will also justify substantial reliefs. What reliefs are planned or discussed? First, the elimination of the risk-based capital calculations in Pillar 1. This would also include the calculation of the capital conservation buffer, the countercyclical buffer, and the systemic risk buffer. Second, the existing Pillar 2 add-ons shall be waived. In addition, certain requirements, like, for example, stress testing, there should only be a top-down approach, or reliefs in reporting and disclosure are discussed. Last but not least, the EBA guidelines, which are often very detailed and a real pain point for small banks, shall be made more principle-based and more proportionate for the needs for smaller banks. Compared to the current system, a small bank regime would be a fundamental new approach. However, there are still open questions, especially the calibration of the leverage ratio. This will now have to be discussed intensively. But the message is clear. There is a need for significant relief for small banks. There is a need for a regulation for small banks that fits reality.
Thanks, Ingmar. To me, personally, highly emotional topic.
Indeed.
And a revolutionary approach. And I'm quite curious how this is going to develop and be discussed in Europe. So we've now presented the two key points in the simplification debate so far. But the debate is not going to stop here. UK has just published last week, I believe, its proposal for the implementation of what we call Basel IV. The US are supposed to come out with it by March. In both jurisdictions, capital requirements have already been reduced. In the US, a lot. And are expected to be reduced even further. Europe, instead, will see an increase of capital, and I'm soon going to explain this. And we believe that the current levels of capital are more than enough. On the next slide, you see, therefore, three proposals which will surely be highly debated. I start with the one in the middle, the output floor. Those of you familiar with the topic, they know that this instrument was the main reform of the so-called Basel IV reform, Basel 3.1, or the end game. It is designed for model banks, the large banks, mainly in order to make sure that their capital requirements are not higher than 72.5% of what they would calculate by the standardized approaches. The increase in capital would have been so high that when Europe debated the CRR, there were so-called transitional arrangements implemented for credits to unrated corporates, for residential real estate mortgages, for derivatives, and for unconditionally cancelable commitments, which are mostly credit lines. They will run out at different times, the latest by 2032. And whenever they run out, they will lead to a capital increase for those institutions having these assets on the portfolios. And for many of the large European banks, this is going to lead to significant effects. Since we believe that the current capital requirements are sufficient, and we are not the only one, this opinion is being shared throughout the European industry, we asked, pledged for making the transitional permanent. And I believe that this is going to be one of the major discussion points of this year. But there's another one. It's an old issue, but has never been more important than it is nowadays. Sebastian, what can you tell us about software?
Well, indeed, the prudential treatment of software assets is a delicate topic. It's because, as you probably know, banks work primarily with information. So they rely on information technology and thus software. But still, despite its importance, in Europe, software is not risk-weighted. Instead, banks must principally deduct software investments or software as an intangible asset from their capital. Or put even more strongly, software is prudentially penalized. To be fair, there is a limited prudential amortization relief up to 3 years, but it has proven to be of very limited capital effect. And it happens always under supervisory scrutiny. The problem here is pretty straightforward. The current framework generally has very low incentives for digitalization. On the contrary, every euro invested initially erodes CET1. Meanwhile, in the US, software is not deducted, but risk-weighted as other assets. With AI likely to drive larger IT programs, this rule puts EU banks at a disadvantage in very crucial times. Our proposal is therefore very clear and simple. Eliminate the prudential CET1 deduction for software. Treat software like other assets with a 100% risk weight. Simple, predictable, and investment friendly.
Yeah, and the third one, the lock on the slide. Ingmar, what does this one refer to?
This refers to the NPL backstop. Yeah, the backstop was introduced against the backdrop of high NPL ratios in the wake of the sovereign debt crisis in Europe after 2010. The NPL backstop forces banks to cover non-performing loans with equity within a certain time limit. And indeed, Europe had an issue with high NPL ratios in the past. In 2012, the NPL ratio in Europe was around 7.5%. Last year, it was only 1.9%. So that means that the regulatory rationale for the backstop has ceased to apply. Why is the backstop so problematic? The problem is that the rigid requirements, especially the high coverage ratio after certain time limits, are not risk sensitive and are not in line with accounting requirements. That means, although non-performing loans are adequately covered by accounting risk provisions, for example IFRS 9, have to be covered with equity in addition. The strict rules use up capital too early and restrict lending too soon, especially for the commercial sector, instead of supporting bank-led restructuring. This has negative effects for the bank, its credit lending, and the whole European economy. Furthermore, the backstop only exists in the European Union. The United Kingdom abolished the backstop 2 years ago. That means for European banks, the backstop has significant competitive disadvantages. To conclude, we do not need a backstop that holds Europe back. We need a modernized backstop. This could, for example, be achieved if the backstop only applies once an NPL ratio of the bank exceeds 5%.
Thank you, Ingmar. We have now come to the end of the topics we wanted to present to you. And now I can have a look to the questions being asked by you. There's an interesting one. Europe has developed a regulation for the last 15 years for good reasons. Don't you see the financial stability at stake? Sebastian, do you want to take that one on?
Sure. Well, first of all, I think that's a valid question. But I would like to respond. I want to raise three different aspects. So first of all of the player involved until now, or many of the player involved, at least from the authority side, always stress simplification does not mean deregulation. And we agree, kind of. So if we have double counting of risk in the system, getting rid of it could reduce capital requirements, but it does not decrease the financial stability in the system. This is one important point. So there are inefficiencies we can get rid of. The second one is, if you have listened closely, most of the point that we've raised, for example, unrated corporates in the context of the output floor, this is about future capital increases that diverge with other jurisdictions, because in the US, capital does not increase. Meanwhile, in Europe, we have all these discussions about green transformation, defense spending, digitalization. This will need capital, but now the plan is, at least for banks, they will have to increase their capital until 2032. The last point I would like to respond is that we have the EBA and the ECB. They are saying that we could cut reporting requirements, for example, by 25%. That's their goal, just like that. And my gut tells me that this can be done equally in other areas of regulation, because regulation can also just lead to costs, because people need to work on this regulation. And this also puts European banks at disadvantages and raises prices.
Well, to tell you the truth, Sebastian, my personal conviction has always been there's so many instruments out there. Even if you cut half of them, they still have sufficient to raise up the capital to the level they desire to have it in the system. That's mine. There's another one. This is one for Ingmar. Small banking regime. Will it come true or not?
I think it's not easy, but I think the chances now are very high, because when we discussed this topic of proportionality and reliefs to small banks for so many years, and we just also had nitty-gritty discussions about certain templates, get rid of it, etc. But now we have this proposal of a small bank regime, a fundamental regime change. And I think if not now, when then? So I think let's work on it.
Yeah, let's work on it. Time's up. Thanks for joining, and see you next time. Bye-bye.